I can't afford to lose money. I need safety. I want growth, but I also want to sleep at night. I'm willing to take risks for bigger returns. 3 investors. 3 strategies. 1 question. What's your 2026 investment plan? Let's find out. There's no one-size-fits-all investment strategy. What works for a 25-year-old is completely different from someone 5 years from retiring. Major banks are forecasting the S&P 500 could reach over 7,700 in 2026, but volatility is pretty much guaranteed. According to Reuters, the real question isn't just should I invest, but how should I invest based on my situation? Today, I'm breaking down 3 complete strategies from start to finish. First, the conservative plan, focused on capital preservation and steady growth. Second, the moderate plan for balanced growth with managed risk. And third, the aggressive plan, aiming for maximum growth with higher risk. We're talking real numbers, real allocations, and real expectations. Let's dive in. First, you have to know your profile. A conservative investor is usually within 10 years of retirement, can't afford significant losses, and gets stressed out by market volatility. They likely need their money within the next 5 years. Think of Sarah, who is 58 with $400,000 saved. She's retiring at 65 and just can't risk a 30% drop. Then there's the moderate investor. They're typically 10 to 25 years away from retirement, can handle some volatility, and have a solid emergency fund. They're prepared to ride out market cycles. This is Marcus, 42, with $200,000 invested. He has a stable income, a 6-month emergency fund, and wants growth without extreme ups and downs. Finally, the aggressive investor. They usually have 25 or more years until retirement, a strong income, and plenty of emergency reserves. They can handle significant volatility and won't need to touch this money for decades. A great example is Jessica, who is 28. With a stable job and a 30-plus year horizon, time is on her side to recover from any market swings. So, which one are you? Remember, there is no best strategy, only the strategy that is best for your situation. Let's start with the conservative strategy. The goal here is simple: protect what you have while generating reasonable returns. For your portfolio allocation, you'll put 60% into broad market ETFs like SPY, VOO, or VTI. This gives you instant diversification and decades of proven performance. The S&P 500 has averaged around 10% annually over the long term. Next, you'll allocate 30% to high-grade bonds through ETFs like AGG or BND. These act as a safety net when stocks decline and provide stable income through interest. They could even benefit from potential rate cuts in 2026. Another 8% goes into cash or a money market account, which is currently paying 4 to 5% interest. This gives you liquidity for emergencies and acts as an opportunity fund if markets drop. Finally, a very optional 2% can go into a Bitcoin ETF like IBIT. This gives you regulated exposure to digital assets. If Bitcoin rises significantly, you get to participate. If it drops by 50%, you only lose 1% of your total portfolio. So, for a $100,000 portfolio, it would look like this: $60,000 in SPY, $30,000 in AGG, $8,000 in a money market, and $2,000 in IBIT. The expected return is about 6 to 8% annually, with a maximum drawdown of 15 to 25% in severe markets. This won't make you wealthy overnight, but it protects your capital while providing reasonable returns. Now for the moderate strategy. The goal here is to capture meaningful upside while managing the downside. For your portfolio, 60% goes into growth stocks and ETFs. Within that, 40% is in broad market ETFs like SPY or QQQ. Then, you can add individual stocks, 7% in NVIDIA, the AI infrastructure leader, 6% in Microsoft for its AI monetization, and dividends, and another 7% in other growth names like Apple, Broadcom, or Visa. Next, 20% of your portfolio is dedicated to thematic ETFs. Think about robotics with BOTZ, or quantum computing and AI with QTUM. Another 10% goes to bonds and alternatives. You could put 5% in investment-grade bonds like AGG, 3% in real estate investment trusts like VNQ, and 2% in commodities like gold through GLD. The final 10% is allocated to crypto. You have two options here. Option is through ETFs, 6% in a Bitcoin ETF and 4% in an Ethereum ETF. Option B is direct ownership, 6% in Bitcoin, 3% in Ethereum, and 1% in Coinbase stock. A critical rule here is to rebalance quarterly. If crypto runs up to 15% of your portfolio, sell it back down to 10%. If it drops to 5%, buy more to bring it back up to 10%. For a $100,000 portfolio, that's $40,000 in broad market ETFs, $20,000 in individual stocks, $20,000 in thematic ETFs, $10,000 in bonds and alternatives, and $10,000 in crypto. The expected return is 10 to 15% annually, with a maximum drawdown of 25 to 35% in rough markets. This is best for people aged 30 to 50 with a solid emergency fund and stable income. All right, let's talk about the aggressive strategy. A quick warning, this approach can generate significant returns, but it can also lead to substantial losses. If you can't handle a 40 to 50% decline without panic selling, this is not for you. The goal is to maximize long-term returns by concentrating on high-growth sectors. Your portfolio allocation starts with 40% in AI and tech leaders. This means 15% in NVIDIA, a maximum conviction play, 10% in Microsoft for its AI, and stability, 8% in Broadcom for custom AI chips, and 7% in Palantir for enterprise AI. Next, a significant 30% goes into major crypto assets, 15% in Bitcoin, either directly or through ETFs, 10% in Ethereum, and 5% in Coinbase stock. Another 15% is for speculative plays. This could be 7% in small-cap tech stocks, 5% in DeFi protocols, but only if you truly understand them, and 3% in emerging tech like quantum computing or biotech. Then, 10% goes into thematic ETFs like ARK Innovation, QTUM, or BOTZ. Lastly, you keep a 5% cash reserve to seize opportunities when markets drop. So, on a $100,000 portfolio, you'd have $40,000 in AI and tech stocks, $30,000 in crypto, $15,000 in speculative plays, $10,000 in thematic ETFs, and $5,000 in cash. The expected return is high, around 15 to 25% or more, but so is the variance. You have to be prepared for a maximum drawdown of 40 to 60% in a severe market downturn. This is a concentrated bet on AI continuing to drive returns. If that trend breaks, you will underperform significantly. This is only for investors under 35 with stable income, emergency funds, and a genuinely long-term horizon. So, how do you actually build your chosen portfolio? First, start with your core positions. For the conservative plan, buy your broad market ETF and bonds first. For moderate, establish that 60% stock position, then add the thematic ETFs. For aggressive, build your AI core before touching the speculative plays. Second, if you're investing a lump sum, dollar cost average by spreading it out over 2 to 3 months. Third, set a rebalancing schedule. Conservatives should rebalance annually, moderates quarterly, and aggressive investors should rebalance monthly or whenever a position drifts by more than 5%. Fourth, automate your investments. Set up automatic monthly contributions to your core positions to stay consistent. Finally, check your portfolio monthly, not daily. Daily checking just increases anxiety and leads to bad decisions. Some common mistakes to avoid are changing your strategy mid-year based on market moves, comparing your returns to others, abandoning your plan during volatility, and over-concentrating in winners without rebalancing. So, how do you choose your path? Choose the conservative plan if you need the money within 10 years, lose sleep over volatility, or are close to retirement. Choose the moderate plan if you have a 10 to 25-year time horizon, want growth with managed volatility, and have a stable income and emergency fund. And choose the aggressive plan only if you have over 25 years until retirement, a strong income, and can stomach major volatility. The truth is, most people overestimate their risk tolerance in bull markets and underestimate it in bear markets. If you're unsure, start with the moderate plan. You can always get more aggressive later. It's much harder to recover from panic selling. You can even mix strategies like 70% moderate and 30% aggressive. In the end, no matter your style, conservative, moderate, or aggressive, there is a data-driven approach for 2026. We covered the conservative 60/30ths, 8 have split for capital preservation, the moderate 60/20ths, 10/10ths for balanced growth, and the aggressive 40/30ths, the 5th of October 15 for maximum returns. The best strategy isn't the one with the highest potential returns, it's the one you can actually stick with through all the market as cycles. Choose based on your situation, not your emotions or what everyone else is doing. Drop a comment below and tell me which strategy fits you best. Subscribe for more practical investing content based on data, not hype. Hit that like button if this video helped clarify your investment approach, and share it with someone who's trying to figure out their 2026 strategy. Remember, the goal isn't to build the perfect portfolio. It's to build a portfolio that works for your life, your goals, and your risk tolerance. Build your plan, stick to it, and only adjust when your life changes, not when the markets fluctuate. That's how you win in 2026 and beyond. Thanks for watching. I'll see you in the next one.